Hello everyone, I'm Chloe and I'll be reading Glassnode newsletter week 50. Bitcoin bulls attempt to hold the $50,000 price level as strong demand pulls coins out of exchanges. However, network profitability suggests this may be the bull-bear line in the sand. The Bitcoin market has attempted to regain its footing following a tumultuous and volatile deleveraging event last week. Bitcoin prices were largely range-bound, opening at $59,368 and trading between a high of $51,900 and a low of $56,942. After significant market volatility like last week's deleveraging event, it's valuable to assess the broad investor response, changes in spending patterns and sentiments, and new emerging trends that are observable in on-chain and derivative data. To achieve this goal, this week's newsletter will make comparisons between the recent deleveraging and market structure experienced through May to July. Discussion of the points above will aim to provide context to the current state of Bitcoin markets and where we are within the Bitcoin accumulation and distribution game. Realization of profits and loss. After large price drawdowns, it's natural for some holders to realize losses. Out of fear the market is due for further downside or encapsulation as well below the holder's cost basis. We are currently observing an acceleration of realized losses among holders, trending above $1 billion daily on 2 occasions during this correction. While realized losses only directly show underwater supply being spent, we typically assume this reflects an upper bound magnitude on new set pressure as coins enter back into liquid circulation. If we compare the current deleveraging to the one in May, we can see May-July drawdown shows a deceleration in realized losses after the initial capitulation event as top buyers transferred coins to exchanges for sale. October-December drawdown shows an acceleration in realized losses, indicating a more trigger-friendly and cautious approach by the market, potentially indicative of nervousness of further downside. However, a key difference between these two events can be seen in exchange net flows and the impact on overall exchange balances. In May-July, exchanges saw an enormous influx of some 168,000 BTC on net over a span of 3 months. In the current October-December correction, we have seen a total of 49,000 BTC flow out of exchanges, making for quite the contrast. Looking to exchange net flow volumes on a 7-day EMA basis, we can see that the current market is firmly in the regime of net outflows, with 3,000 to 5,000 BTC in daily outflows common. Overall, while these significant losses are most certainly being realized on-chain, they are being met with a significant and arguably overwhelming demand. We can also look to market momentum using the 28-day market realized gradient, MRG. This tool measures the relative momentum between price action, market cap, and capital flows on-chain, realized cap. High or descending values have historically provided a signal to take caution, and the low or ascending values have historically provided a signal for a more risk-on approach. Current MRG values display Bitcoin as being in an oversold state, with historically low MRG values. However, the metric has yet to fully level out and plateau, indicating that price and capital flows are both still attempting to really establish a healthy equilibrium. Early confirmation would be found on a technical break higher, and full confirmation with a break back above zero bound. The other side of the on-chain equation are investors realizing profits, whom are most often longer-term holders. The magnitude of realized profits is in a similar decline to that seen in the first half of 2021, suggesting that fewer profitable coins are spent as the correction proceeds. This is partly due to the low prices, but also signals that the in-profit holders are not as interested in spending at current levels. However, declining realized profits in January and May occurred alongside a topping price pattern, suggesting weaker demand as time moved on. Declining realized profits during a correction, as seen in May to July, and at present likely indicate a returning conviction and a reducing desire to divest at these prices. A significant return to elevated values in this metric, especially if accompanied by price weakness, would be cause for concern, however, as it would be likely indicate deteriorating conviction among the in-profit cohort and a fear of further downside. The aftermath of deleveraging. As the Bitcoin market matures, derivative products have become an increasingly relevant influence on price action. Following a deleveraging event, it is also important to assess whether the market is adding more leverage as traders long the dip, or whether the market remains cautious to respond to the volatility. This influence of futures market on price is particularly dominant during periods where futures open interest climbs above the 380,000 BTC level. It becomes particularly concerning after a strong price run-up and the extended period of realized profit prints we observed earlier, as strong hands on traders transfer coins to newer holders whom have a higher cost basis and are more sensitive to volatility. High future open interest provides fuel for a volatile, futures-driven move. These factors were both prevalent in the May and November tops, which results in a cleansing of futures open interest back to 340,000 BTC. Note, however, that open interest has climbed by around 5,000 BTC over the last week. A key metric to watch from here is whether open interest starts to climb aggressively. This would indicate a higher chance that liquidation levels and stop loss are clustering around the current trading range, and increased expectations of derivative-led volatility. Perpetual futures funding rates are a core data point for assessing the market directional bias. Funding rates help peg the price of these futures as closely to the spot Bitcoin price as possible by making longs pay shorts green when perpetual futures price is larger than the spot price, making shorts pay longs red when spot price is larger than the perpetual futures price. Extreme values in funding rates have historically signaled peak euphoria or misery for market participants, often correlating with local market highs and lows, respectively. Before the drawdown last week, we witnessed a local euphoria, evidenced in the large relative spike in funding rates, almost precisely at the market all-time high. At the lows of this week, we experienced the opposite, with the first negative print since the $40,000 lows in October. While some of this is due to the deleveraging event that took place, two things are worth considering. Leveraged traders were forced to close their positions, clearing out stop losses and liquidation levels down to $45,000 and even lower on some exchanges. Funding rates are only slightly positive at present and are not climbing significantly. This adds further evidence that a large majority of excessive leverage has been cleared from the market. Similar to open interest, this is a metric worth keeping an eye on. Futures volume also spiked during the event, which has historically provided notable pivot points in price action. On the most recent impulse futures volume in aggregate was 2 million BTC. While this sum in futures volume is significant, it remains relatively small compared to both the May and September drawdowns. Furthermore, it is part of the consistent decline in overall volume that has been established since May. This seems counterintuitive as price has more than doubled to all-time highs since then, and the price increases would seem like an appropriate pairing with increased trading volumes. Note also that the volumes are also down on a USD basis versus early 2021, so it's not a function of higher prices equating to less BTC traded. This change could therefore be a combination of futures traders having a low risk appetite after historic May 2021 drawdown, traders taking their funds to other markets such as altcoins. I view the Bitcoin markets are still in effect in a longer-term macro constellation, digesting the appreciation, volatility, and rapidly changing global events since this time last year. After a deleveraging event, it is typical that spot markets, and thus on-chain data, return as a dominant forcing function for dictating price movements. A useful tool for identifying this transition between derivative-led and spot on-chain-led market structure is to look at perpetual future open interest as a proportion of the Bitcoin market cap. High values over 1.3% signal derivative dominance. Low values less than 1.1% signal spot dominance. While these values have not reverted to historically low levels, such as those seen in May, they've returned to much healthier levels, previously seen throughout the late 2021 move from $30,000 to $60,000 plus. This further supports that a meaningful deleveraging event has occurred, and the market appears to be responding with caution rather than levering up once again. Finally, we'll close out with investor profitability. We can use net unrealized profit loss, NUPL, as a gauge for when additional sell-side may be activated should Bitcoin prices languish or decline further. The historical battleground for bulls and bears sit at a network-wide profitability of 50%, meaning half of the Bitcoin market cap is held as an unrealized profit. In bear trends, this zone provides resistance, as holders are increasingly willing to cut their positions at moderate profit, as can be seen in the May to July price action. In bull trends, this zone provides support from holders looking at their profitable positions, as can be seen through August to November. Per this chart, the current leg down in price seems to resemble a correction with a large bull trend, a stark contrast to May, where NUPL sliced cleanly through the 50% level. However, the transition between this area marks the difference between belief denial, green coloration, and optimism anxiety in yellow coloration, an appropriate description for current holder sentiment at present. As the Bitcoin market consolidates, it appears that derivative markets have taken more of a backseat relative to spot markets, and a meaningful deleveraging event has occurred. There are signs conviction is returning to spot investors and demand remains significant. However, the market still sits atop a key level of psychological support, as seen in the NUPR metric. It is possible that this trading range is defining the bull-bear line in the sand, and the key risk is whether a possible transition into less favorable conditions occurs, should it fail to hold. Thank you so much for watching, and I'll be sharing more in the future.